Whenever you think of opening an IRA, 401k, or any other type of tax-deferred plan, you need to ask yourself this question first. Should you defer the taxes? There's absolutely no question that your money has the potential to grow faster if you do defer the taxes you owe when you earn that money. But when you don't know the tax rate you'll pay on that money in the future, this is a gamble that may not be sustainable for you. And remember, when you defer taxes, you're most likely assuming some risk trying to earn a rate of return. Let's see if this is a good idea. First, some background around taxes. Since the mid-1980s, income tax rates in the United States have stayed relatively low. This is because of the presidential policies of Ronald Reagan, George Bush, father and son, and Donald Trump. But these extremely low rates can't last forever because there's an ever-increasing load of government debt. You see, with lower taxes, the government did not stop spending. Instead, politicians, both Republican and Democrat, piled on debt. And they've kept adding or expanding entitlement programs which benefit many people who never pay taxes into the system at all. As of February 2019, U.S. government debt exceeds $22 trillion. $2 out of $3 of that $22 trillion is represented in U.S. Treasury bills, notes, and bonds. The rest is liability on programs like the Social Security Trust Fund. This debt belongs to U.S. citizens. Now, on top of this, you have $210 trillion in liabilities that the government has promised to deliver in the future. This makes $22 trillion of debt look tiny, but $22 trillion is more than the entire U.S. GDP for 2018. State governments have also piled on debt and future liabilities. This is a lot of money, and governments will need to collect this money in taxes someday, some way, or at least the interest on it. So will taxes go up in the future? Easy answer. The writing's on the wall. It's not a matter of if taxes will go up, it's a matter of when. So ask yourself, is it worth deferring tax today when you expect tax rates to be higher in the future? Does that make any sense? Now, let's look at your tax-deferred money from a safety perspective. You've probably heard that various government programs like Social Security are underfunded. That's true. This means those programs will run out of money at some point in the future unless the government finds more money. Of course, Congress can always reduce benefits. They might do that, but it would be very unpopular. So what else might they do? Well, ever since the Clinton years, Congress has been eyeing tax-deferred retirement plans as a pool of money they could seize to spend. But could they really get to this money? France, Ireland, Hungary, and Argentina have all renovated their private and public pension plans, so sort of international precedence has already been set. Now, the United States tends to be more favorable toward private property than some of those countries. So rather than directly seizing retirement plans, Congress might simply vote to tax them differently. A new tax rule, a distribution rule, or simply higher tax rates would do the trick. However they come, higher taxes seem to be coming, and tax-deferred retirement plans are an obvious and easy target in more than one way. So, if you have a chunk of money saved that you could use tomorrow, would you rather have tax-deferred savings or never taxed savings? Which is better when you go to use the money? Let us know what you're thinking in the comments below. Finally, let's take a look at some growth and distribution details. Typical money in an IRA or 401k invested in target date mutual funds is projected to earn between 6 and 10% through 2050. But if you're looking at an earlier retirement date, these projections drop to somewhere between 2 and 5%. Now, of course, such projections are at risk and they really provide zero guarantees because they are just projections, nothing else. Even so, if you contribute $1,000 a month to your 401k over the next 30 years and you can earn 6%, you would have just over $1 million before you pay taxes. Taxes could easily take a third, leaving you with roughly $685,000. But if you pay your income tax now and then put $1,000 a month toward a well-designed participating whole life insurance policy, the cash value in your contract after 30 years is quite comparable to the after-tax value of the 401k. Now, using whole life insurance as a financial tool can provide you more sustainable income options, as well as a permanent death benefit. Check out the Retirement Income Strategy link below for details. A good whole life insurance policy can also allow you to access a part of your death benefit early if you should encounter chronic, critical, or terminal illness. This is partly because the never taxed life insurance policy never forces you to pay Uncle Sam a dime on the tax-deferred growth you experience over the lifetime of your policy. Contrast this to a 401k or IRA. These plans come with required minimum distributions. Money in typical tax-deferred plans will be taxed someday, some way. And consider this. When you or your spouse dies, the remaining spouse will usually inherit all the assets, including assets left in retirement plans. Taxes on the same amount of income drawn from these plans will now usually incur a higher tax rate because the surviving spouse must file as an individual instead of married filing jointly. This is called the widow's penalty. What if the surviving spouse could access some never taxed money from life insurance values? This means less taxable income with the same amount of money to spend. That's a good thing. Then there's estate taxes. The value of any tax-deferred accounts left as an inheritance will be added to the estate of the deceased person. If estate taxes need to be paid, beneficiaries might take a distribution from the retirement accounts. If they do, this triggers income and income tax for the beneficiary. Another distribution from the plan might become necessary to pay the tax. The new distribution will be taxed as income also, and this creates a snowball effect which can be devastating. On the other hand, a whole life insurance death benefit is income tax free. In fact, whole life insurance is often used in estate planning just to ensure liquidity for paying estate taxes without liquidating any assets. At the end of the day, one of the best ways to protect you and your loved ones from unnecessary taxes is by using participating whole life insurance. What if you've saved all your life in tax-deferred plans? Are you stuck? Certainly not. After age 59 and a half, you can take distributions from your tax-deferred retirement accounts, avoiding the 10% penalty. Yes, you'll have to pay the tax, but you'll have to do that whenever you take the money. You can pay the tax on these distributions, then use them to pay premiums on an existing or new whole life insurance policy. The life insurance builds cash value, which you can access and use in various ways without facing required minimum distributions or the taxes on those required distributions ever again. When you do it right, this can save you a nice amount of money on taxes and allow you more money to spend tax-free over the rest of your lifetime. When you pass, there will be a death benefit for your spouse or whoever your beneficiary may be, and the money from that death benefit is totally income tax-free. Positioning money to never pay taxes again is a good thing. In summary, remember, number one, government debt is high and governments will need more money in the future to meet obligations and promises. Number two, taxes are lower today than they have been historically. Number three, access to never taxed money allows you to live longer without running out of money. That's important. Number four, never taxed money can multiply your legacy without reducing your lifestyle. To see if this strategy could be a good fit for you, call our office at 702-660-7000 or schedule a call with the link below. If you enjoyed this video, please give it a thumbs up and subscribe for more.